UPS stock is currently trading near its 52-week low, down 37% over the past year and nearly 50% in the last 5 years. In this video, I'll take you through an in-depth analysis of the company, examining its financials, balance sheet, and key performance metrics. I'll also use my DCF model to estimate the stock's intrinsic value. What makes UPS especially attractive to many investors right now is its high dividend yield, which currently sits at 7.9%. The majority of that dividend growth actually came from just one period, when they increased the dividend from 2021 to 2022. And if you look closely at what's been happening with free cash flow, it's easy to see why. In 2020, free cash flow was a little over $5 billion. Then, in 2021, it hit a record, more than $10 billion. In just 1 year, free cash flow more than doubled. It stayed strong in 2022 as well. But 2023 and 2024 told a very different story. In 2023, free cash flow dropped back to around $5 billion, basically the same as 2020. Right now, the free cash flow cannot cover the dividend as the payout ratio, which is what percentage of their profit is used to pay the dividend, is at 97%. When we're talking about high-yielding stocks, the main reason investors buy them is, of course, the dividend, which means you need to be confident that dividend is sustainable. In this case, there is a high chance that the dividend might get cut. In the last few years, not only their profit, as we have seen, has been declining, their revenue has fallen from $100 billion in 2020 to $90 billion currently. And this company has not great margins, as profit margin is 6.3% and free cash flow margin 3.9%, again with a significant drop in the last couple of years. If we take a closer look at their investor presentation, I always look at their capital allocation. Why? Because it's management's single most important responsibility. At the end of the day, how they decide to use free cash flow ultimately shapes the company's future. And just as a quick recap, there are only 5 ways you can use free cash flow: reinvest back into the business, pay down debt, pursue mergers and acquisitions, buy back shares, or return cash to shareholders through dividends. Now, here's what the numbers look like so far this year. Free cash flow about $742 million, dividends paid about $2.7 billion, share repurchases already around $1 billion. The problem is obvious. They haven't even generated enough free cash flow in the first half of the year to cover the dividend. And when that happens, there's no capital left for reinvestment or debt reduction. So how do they keep funding dividend payouts when free cash flow isn't enough? By leaning on the balance sheet, either drawing down cash reserves or taking on additional debt. That's not a sustainable long-term strategy, and it raises serious concerns about the company's financial health. But this sharp drop in price raises an important question. Is UPS undervalued and worth buying right now? To find out, I ran the numbers using my Google Sheet valuation model. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $48 per share, middle $74 per share, and high $108. And because the stock is currently trading at $82 per share, this means that if my low assumptions occur, you will get a 0.5% annual return on your money, middle 8.1%, and high 15.3%. These returns include the dividend. So this is a stock you'd only consider buying if you believe in my more aggressive assumptions. Regarding the assumptions, I have UPS growing revenue between 0 and 4% over the next 7 years, averaging a profit margin and free cash flow margin between 4 and 6%. And I assigned a PM price to free cash flow at the end of the 7 years of 13, 15, and 17. Right now, UPS is trading at a PE ratio of 12, but its price to free cash flow sits at 20. Based on those metrics, I'd say the stock is trading at a fair valuation. It doesn't look deeply undervalued despite the recent drop in price. Looking at the balance sheet, UPS is in a decent position with around $6 billion in cash, though it carries about $28 billion in debt. That's manageable for a company with a 70 billion market cap, but it becomes more concerning when you factor in the significant cash outflows required to sustain its dividend. So, what lies ahead for UPS? Their latest quarterly results show revenue down 2.7%, largely due to falling volumes. In fact, average daily volume declined 7.3% year-over-year in the second quarter. For a business like UPS, this is a major headwind, because when volumes are shrinking, it becomes increasingly difficult to drive revenue growth. At the end of their presentation, UPS provided guidance for 2025. Right away, they highlighted several uncertainties, such as tariff and trade changes, as well as the potential impact on consumer behavior. That's not exactly the clarity investors are looking for. On top of that, management pointed out increased variability in both SMB and enterprise volumes, which again ties back to their ongoing struggle with declining demand. Some of their newer initiatives also remain unproven, adding another layer of uncertainty. What we do know is that UPS is projecting total dividend payments of around $5.5 billion. That's the critical number. They need at least $5.5 billion in free cash flow just to cover the dividend. Last year, free cash flow came in at about $6.2 billion, which was barely enough. But in the most recent quarter, volume was down and revenue fell about 2%. So whether they can consistently generate enough cash to support that dividend is definitely a concern for me. However, analysts are expecting improvement as they have UPS reaching $103 billion in 2029 and $10.81 per share, which would put them at a forward PE of 7. On the other hand, more bad news. Not long ago, the company announced plans to cut around 20,000 jobs. On one hand, you could argue this is bullish. Lower expenses could lead to a higher bottom line. But it's important to look at the why these cuts are happening. In this case, UPS is parting ways with Amazon, its larger customer. Another bearish development, impacting both UPS and FedEx, is the end of the de minimis rule. This rule previously exempt packages valued at $800 or less from certain duties when entering the US. Now that the exemption is gone, the company will be affected either way. They can absorb the additional costs or pass them on to consumers. If costs are passed on, it could lead to fewer orders or shipments, which would negatively impact volume. In conclusion, while UPS's weakening fundamentals have driven a significant drop in both its stock price and valuation, I don't see this as a clear value opportunity. In my view, the stock still isn't cheap enough, because just trading at lower levels doesn't automatically make it undervalued. I hope you found this video valuable. Let me know what you think about UPS stock in the comments, and I'll see you in the next one.